Studies show that a significant percentage of Americans are taking early distributions from their retirement accounts. And what this means is that not only are they depleting their retirement savings, but in many cases, those distributions are being subject to a 10% additional tax. This is in addition to any income tax that is owed on the distribution. And so the question for us becomes, is there a way that we can help those clients avoid paying that 10% early distribution penalty? The answer is yes, because when a distribution is taken from a retirement account and it's subject to the 10% early distribution penalty, there are options under which the 10% early distribution. The question becomes how. One of the ways in which the 10% early distribution penalty can be waived is if the distribution is part of a substantially equal periodic payment program. SEPP for short, also referred to as 72T because it's governed by Internal Revenue Code section 72T. Now, earlier this year in 2022, the IRS issued Notice 2022-6, in which they explained that many of the governing rules for 72T payments have changed. And these rules become effective 2023 and are optional for 2022. My name is Denise Appleby, and today we're going to be talking about these rules and some of the factors that must be taken into consideration if you are considering having your client engage in a 72T program. The objective here today is to understand and be able to explain to clients, when would a distribution be subject to the 10% early distribution penalty? And let's assume that it has been determined that a client will be subject to the penalty. How do we determine if that client is a suitable candidate for a 72T program, which can be used to avoid that penalty? And if so, if we determine that a client is a suitable candidate, what are the compliance requirements? Because the rules for the 72T program are very strict. And if they're broken, then the penalties can be pretty significant. Let's first talk about which type of accounts 72T programs can be run from. Pretty much any type of tax-deferred retirement account, IRAs, 401ks, 403bs, and non-qualified annuities as well. But for this session, we're not going to be talking about non-qualified annuities. We're just going to be sticking to IRAs and employer-sponsored retirement plans. Now, one of the questions that comes up is, well, now that we have Notice 2022-6, what does it mean for previous guidance like Revenue Ruling 2002-62? Well, Notice 2022-6 overrides that. So now you can take Revenue Ruling 2002-62 and pretty much put that to the side unless you have clients who started 72T programs before now, because those are still governed by Revenue Ruling 2002-62. Think about the RMD method as well, because I'm going to explain how that works, and you'll see why in some cases the RMD method, even though a 72T program might have started using the RMD method before 2022 or 2023, then they can still be governed under the new rules. Something that we must bear in mind is that the IRS published new RMD tables in 2020, and those become effective for 2022. And for the most part, it means that the calculations that are done using these tables produces, in some cases, lower RMD amounts, in rare cases, higher RMB amounts. Well, the idea behind the new tables is that Americans are living longer. And by using the new tables, it allows them to take lower RMB amounts than would have been taken under the previous version of the tables. And all the tables are affected: the uniform lifetime table, the single lifetime table, and the joint life and survivor table. So let's talk about why we're here today, because usually when we add savings to a retirement account, the objective is to have those savings remain in those accounts until we retire, right? And for most of us, that means after reaching age 59 and a half, 60, 70, but definitely usually after reaching age 59 and a half. But sometimes life happens and we find that we have no choice but to take distributions earlier than planned. And if these distributions are taken before age 59 and a half, they're subject to a 10% early distribution penalty. Now, studies show that a significant percentage of Americans are taking what we refer to as early distribution. Now, by definition, an early distribution is one that is taken before the account owner reaches age 59 and a half. Now, according to the GAO, individuals in their prime working years, age 25 to 55, removed at least $69 billion from their retirement savings account early. And distributions from IRAs represents a significant portion of that, with almost $40 billion. And what does this mean? It means early distribution penalty unless they qualify for an exception. Here's another piece of stat. 37% of workers have taken money from their retirement accounts early in the form of early distributions, hardship withdrawals, loans. And so what this tells us is that there is a significant percentage of Americans out there who need our help with avoiding the 10% early distribution penalty, because let's be real, these individuals are taking these early withdrawals because they need the assets to cover some financial need. And if you are taking money from your retirement account early, you're going to get hit with income tax if the amount is from pre-tax assets, and then the 10% early distribution penalty in addition to that. So already the amount that is withdrawn to cover a financial need is being reduced by income taxes and the 10% early distribution penalty in most cases. Now, the goal is to encourage individuals to at least wait until age 59 and a half to take these distributions, because then the 10% early distribution penalty won't apply. And one of the questions that usually comes up is then, when does someone reach age 59 and a half? It seems like a simple question, but not really. The tax code says someone reaches age 59 and a half 6 months after their 59th birthday. The challenge is that some financial institutions count this in months and some count this in days. Why is that important? Because I've seen instances where individuals request distribution on what they think is the date that they reach age 59 and a half. And they're thinking, oh, well, I'm avoiding the 10% early distribution penalty, only to find out that when they get that 1099-R statement from the financial institution, it shows that they do in fact owe the 10% early distribution penalty. Why does something like this happen? Because today might be the 6th month after you reach age 59 and a half, but the financial institution might count it in days, maybe 183 days. It depends on whether it's a leap year or not in some cases. So how do we make sure that does not happen to a client? We contact the financial institution and we confirm with them, my client reaches age 59 and a half today, according to the calendar. What does your system say? Because we want to make sure that they're not subject to the 10% early distribution penalty. And if there's any doubt at all it makes sense to have the client wait either a day or two just to make sure that they clearly cross that threshold that will help them to avoid the 10% early distribution penalty. Now, the 10% early distribution penalty is really an additional tax, which means, generally speaking, if no income tax is owed, then no 10% early distribution penalty is owed on the amount. And I say generally because, as with most rules that apply to IRAs and employer plans, there are exceptions, right? Now, another tip. If this distribution is being taken from a simple IRA, that 10% early distribution penalty is increased to 25% if the distribution is taken before the simple IRA 2-year period. Now, the 2-year period starts on the first day that a simple IRA contribution, whether it's employer or employee, is made to the employee's simple IRA. So another item to add to your checklist as you're having that conversation with clients about taking early distributions, is this a simple IRA? Because if it is, now we need to determine whether the distribution is occurring within the 10-year period. Because if it is, then the 10% early distribution penalty would be increased to 25%. Now, as I said before, if there's no income tax owed, then generally there's no 10% early distribution penalty. An exception applies to certain Roth distribution amounts. I'll show you an example of what that means in a little bit. But generally speaking, if someone takes a distribution from a Roth IRA and it's a qualified distribution, it's tax-free and it's penalty-free, no income taxes, no 10% early distribution penalty. Now let's look at a case study with Andy, who is 40-year-old, which means he's under age 59 and a half, yes. Andy takes a distribution of $80,000 from his traditional IRA, and he didn't roll it over. And that's important to note because a distribution that is properly rolled over is excluded from income. It's not taxable, and therefore it's not subject to the 10% early distribution penalty, assuming that the amount is in fact eligible to be rolled over. Now let's look at scenario 1, where we assume that the entire $80,000 represent pre-tax funds. Andy will owe a 10% early distribution penalty of $8,000 unless he qualifies for an exception. Now let's look at another scenario where $70,000 represents pre-tax funds and $10,000 represent after-tax funds, say from non-deductible IRA contributions. Andy will owe an early distribution penalty of $7,000. Why the difference? Because the $10,000 that represent after-tax funds are tax-free and therefore are also not subject to the 10% early distribution penalty. Now, I want to talk about distributions from Roth IRAs in a little bit. And before I do that, I want to remind us what it means for a Roth IRA distribution to be qualified. If your client has a Roth IRA, in order to be able to take a qualified distribution, which would be 100% tax-free and penalty-free, 2 requirements has to be met. Requirement number 1 is that the client has to have funded a Roth IRA for at least 5 years before the distribution is being taken. And notice that I said a Roth IRA, which means that it doesn't have to be the Roth IRA that the distribution is being taken from. It can be from any Roth IRA that the client owns. Now, in addition to meeting that 5-year requirement, the individual must be at least age 59 and a half when the distribution is being taken, disabled, or withdrawing up to $10,000 for a first-time home purchase for an eligible individual. There's also another exception where if the account owner died, then the distribution would be qualified. So those 2 requirements, but except that in case of the death of the IRA owner, course, the distribution would be taken by the account owner's beneficiary. Now, for the 5-year period for determining whether a distribution from a Roth IRA is qualified, that 5-year period starts with the year that the individual funds their first Roth IRA and never starts over, which means that if someone funded a Roth IRA 10 years ago and they fund a new Roth IRA today, and they're taking a distribution from the new IRA that they funded, the distribution would still have met the 5-year period because we're counting from the original Roth IRA. Now that we have established what's a qualified distribution, let's look at a case study where 40-year-old Judy takes a distribution of $100,000 from her Roth IRA and she didn't roll it over. Now let's assume that the $100,000 consists of $10,000 from regular Roth IRA contributions, $80,000 from Roth conversions, and $10,000 from earnings. Now, if the distribution is qualified, if Judy is eligible for a qualified distribution, we know the entire amount is tax-free and penalty-free. But what if she's not eligible for a qualified distribution? Now, if Judy is not eligible for a qualified distribution, then distributions come from the $10,000 first, tax-free, penalty-free, then from the $80,000. Now, this is the exception I referred to, or I alluded to when I talk about there's a sort of funny rule with Roth IRAs, because when Judy takes a distribution, if it comes from the $80,000, that amount is not taxable. However, it's subject to the 10% early distribution penalty if it has been less than 5 years since the amount was converted. And this is different from the 5-year period that I talked about earlier, where it starts when the first Roth IRA is funded. In this case, each Roth conversion stands on their own. And if Judy is under age 59 and a half, when she takes distribution from this $80,000, then the amount's going to be subject to a 10% early distribution penalty unless she qualifies for an exception. And one of those exceptions is, has it been at least 5 years since that amount was converted to a Roth IRA? And distribution of earnings from a non-qualified distributions would be taxable. And in addition, it would be subject to a 10% early distribution penalty because Judy is under age 59 and a half. Now, if she qualifies for an exception, then the 10% early distribution penalty would not apply. Now, just a reminder, IRA custodians do not withhold the 10% early distribution penalty. So when your client checks the withholding box on their distribution form and asks the custodian to withhold 10% or however much, that's for income tax purposes. That has nothing to do with the 10% early distribution penalty. The 10% early distribution penalty is calculated at the time the tax return is being filed and paid along with any other income tax that's owed. Now let's talk about the 72T penalty exception. This penalty exception applies to both IRAs and employer plans, as I stated earlier. Now, someone just can't say, oh, I'm taking a 72T payment. Let me take 100,000 here and 50,000 there. No, the amount must be calculated using IRS safe harbor methods, which includes using one of 3 pre-approved IRS safe harbor formula. And these 72T distributions must continue for 5 years or until the IRA owner reaches age 59 and a half, whichever is longer. And I say IRA owner, but that also includes a participant in an employer-sponsored retirement plan. So what happens if someone starts a 72T program and then breaks the rules? Well, the 10% early distribution penalty would be owed to the IRS on a retroactive basis plus interest. I'm going to be talking more about that later on. But before I do that, let's talk about whether or not a client should really start a 72T program. Let's paint a scenario where someone just lost their job and they need some cash, but the only source of cash that they have is an IRA under age 59 and a half. Should they start a 72T program to avoid the 10% early distribution penalty? Well, the answer is it depends. If this person is looking for a job, it's likely that they'll find a job soon and might not need to continue taking distributions. So starting a 72T program would force this person to be locked into taking distributions that they won't need in the future. So if the need is a short-term or a one-time financial need, then it makes sense to have the client just bite the bullet and pay the 10% early distribution penalty if they don't qualify for some other exception. But starting a 72T program for short-term financial need is not recommended. Also, we want to check to see if a client qualifies for an exception other than the 72T program. So for instance, if the client is taking distributions and they qualify for higher education expenses, and that's the purpose of the distribution, then they won't need to take a 72T distribution because the 10% early distribution penalty would not apply anyway. And one of the questions that comes up here is, well, what are the exceptions to the 10% early distribution penalty? It depends. Some exceptions apply to employer plans like 401ks, some applies to IRAs, and some apply to both. So when you meet with a client and you're having that conversation about whether the client might in fact already qualify for an exception to the 10% early distribution penalty, you want to find out what type of account they're talking about, right? Because let's assume that the client wants to take distributions every year for 5 years to send their child to college. And they're thinking, oh, I can take distributions. It's going to qualify for the higher education expenses. When you look at this cheat sheet here, it shows that the higher education exception applies to IRAs and it does not apply to employer plans, right? So why is this important? Because you want to verify the type of account that the client have before you tell them that they might qualify for the exception. Also, let's assume that the client qualifies for what we refer to as the age 55 exception. Now, under the age 55 exception, distributions from an employer plan account like a pension or a 401k or 403b account are not subject to the 10% early distribution penalty if the participant separates from service in the year they reach age 55 or later, and they take the distribution after they separate from service. Then those distributions are not subject to the 10% early distribution penalty. Now, here's a mistake that is often made. Someone qualifies for this age 55 exception, and then they roll over those assets to an IRA. That exception does not apply to IRAs. And by rolling the amount to an IRA, then they find that they lose the qualification for that exception. And if they don't qualify for an exception that applies to an IRA, then now they owe the IRS a 10% early distribution penalty on distributions that they take before they reach age 59 and a half. So an item to add to your checklist is check to see the type of account that your client have. And if your client is having conversation about moving those assets to another type of retirement account, we need to find out, will the client lose a qualification for an exception by moving those assets to the different type of account? Now, 72T payments can be taken from IRAs at any time. But for employer plans like 401ks, pension, 403bs, they have to be separated from service with the employer that provides the plan before they start a 72T program, right? So another thing that we need to think about, if your client has two types of accounts and you want to set up a 72T program for them, if the assets are in an IRA, then that can be started at any time, assuming that it has been determined that the client is a good candidate for a 72T. But if it's under an employer plan, they cannot do it unless they're no longer working for the employer that provides the plan. Now, one of the concerns that come up with 72T payments is, man, if I start this 72T payment, I won't have anything left for my retirement. But assuming that the market does not drop severely or significantly, all things being equal, there will be funds left in the retirement account. Let's take a look at this example where someone starts a 72T program on an IRA that has a balance of $500,000. And we're assuming that that the account is going to grow at a rate of 5%. We want to be conservative here. And the individual chooses to calculate it over their life expectancy using the annuitization method. They're going to withdraw $30,000 per year. Now notice that at the end of the distribution period, they still have a significant amount remaining in the account. So 72T payments, while it does deplete some of the retirement assets during the program, it's not intended to withdraw the entire balance of the account. My apologies here, just trying to switch slides and it's giving me a little bit of a trouble. Oh, great. There you go. Thank you. So now what I want to talk about is, let's assume that it has been determined that your client is a good candidate for a 72T program. What are some of the key rules that we need to think about to make sure everything's done right? And for today, I want to focus on 10 key rules because there are more, right? The first one is that there are 3 methods available for calculating a 72T payment: an RMD method, the annuitization method, and the amortization method. These are explained in detail in one of your handout. Why is it important to know which method your client should use? Because each method produces a different amount. So usually what I recommend is that you run the calculation using all 3 methods and choose the one that is closest, that gives the closest amount to what your client needs. For instance, if you look at this calculation, you'll see, using the $500,000 that we used in the previous example, under the annuitization method, it's $30,800 per year. Under the amortization method, it's $29,941 per year. And under the RMD method, it's $15,300 per year. So the question becomes, well, how much does your client need per year? Some people might need the full 30, and some people might need only the 15,000. So you choose the method that gives your client the amount that's closest to the amount that they need. And here's something that you need to think about, and this is rule 2. The annual payments must be the same. So once your client starts a 72T program, in this example, you'll see for the annuitization method, it's $30,000 per year. Same for the amortization method. Now, an exception applies to the RMD method, and that's because with the annuitization and the amortization method, once the amount is calculated in year 1, then that is the amount that must be taken for each year of the program, right? Whereas with the RMD method, because it's calculated like a regular RMD in most cases, the amount is refigured each year. And because the life expectancy factor and the fair market value that is used in the calculation will change each year, then the amount's going to change each year. But according to the guidance provided by the IRS, that's perfectly fine. That's one of the exceptions that is permitted. And by using this exception, that will not be considered to have broken the rules. Now, here's a planning tip, because in the example, the previous example, I used an account balance of $500,000. Now, what if when you run the calculation, you realize that $500,000 is too much? Then the next question is, well, how much is enough? And once you have identified how much is enough, then you can run a reverse calculation to determine how much the client needs to give them enough. Once you have determined that amount, then you transfer that amount to a separate IRA and run the 72T program on that IRA. For instance, if you look at the screen here, you'll see that the desired distribution amount is $20,000 per year. And the question becomes, okay, this client has $500,000, but they want $20,000 per year. How much do they need to transfer to a separate IRA that will give them $20,000 per year? And you'll see here that all they need is $333,980. $333,980. So you transfer that to a separate IRA, then you run the 72T program on that amount. Now, I talked about the fact that once you start the program, the amount is predetermined each year. But there are instances where an individual might have started using one method and determined that that doesn't suit them anymore for one reason or another. And in that case, they're allowed to switch to another method. However, they can switch only if they're using the amortization or the annuitization method. And from either one of those, they can switch to the RMD method. No other switch is permitted. They cannot switch from an annuitization to amortization or vice versa. They cannot switch from RMD to any other method. They can only switch from amortization or annuitization to the RMD method. And that switch would happen anytime after the first year that the program starts. And once someone has switched to the RMD method, then they're locked in. They cannot switch back. Now, there's a cap on the interest rate that can be used to calculate a 72T calculation. And for this purpose, the really only applies to the amortization and annuitization method, because there's no interest rate that is used when you're calculating the RMD method. So for the amortization and the annuitization method, the interest rate is capped at the greater of 5%, which is new on the notice 2022-6. Before that, it was only 120% of the federal midterm rate for either of the 2 months immediately preceding the month in which the distribution begins. So now you do have that 5%, which gives some flexibility. Now, how do you get the 120% of the federal midterm rate? Well, the IRS publishes that rate every month. And here I've included a link to the location where the IRS publishes and store these online. Now let's take a look at an example of how they work. We're looking at the midterm rate for October 2022. And remember, the cap is 120%, right? So here we're looking at October. We scroll down to the midterm rate and you'll see for 120%, it's 3.94. Then we go to September and we use the same process where it's 3.52. Now, when we're calculating a 72T payment for November 2022, we can use any one of those two preceding months, right? Or 5%. We can use the maximum of whatever applies. In this case, 5% would be the maximum because it's higher than 120% of either of those months. Now, remember that the 5% is a maximum amount, which means you can use lower if the client doesn't need to use the full 5% to get what they need. How does this new rate affect 72T calculations? Well, under the old method, where we didn't have the 5% interest rate to use, the maximum amount would have been $25,684 using the annuitization method. And under the new rules, because we can go up to 5%, it's $30,812. So now for your clients who want to take more, they have that option to increase the amount that higher than what they would have been able to take under the old rules. A planning strategy is to play around with the interest rate to see which one gets your clients closest to the amount that they need. And just make sure that whatever interest rate you use do not exceed the maximum amount. Here's another rule that has a wiggle room. There are 3 life expectancy tables that can be used. The single life expectancy table. Now, this is different from the RMD rules because remember, under the RMD rules, a single life expectancy table could only be used for an inherited account, right? Not for the account owner, only for the beneficiary with the inherited account. But for 72T rules, it's a little bit different. They can use a single life expectancy. They can also use the uniform lifetime table, which assumes that the account owner has a beneficiary that's 10 years younger than they are, just like you can with regular RMDs. And they can also use the joint life expectancy table, which uses the age of the actual beneficiary. And this can be used as long as they have a beneficiary that's a person. This also is different from the RMD rules because under the regular RMD rules, you can use the joint life table only if the account owner has a spouse as the beneficiary that's more than 10 years younger than the beneficiary, and the spouse is the sole primary beneficiary. And when we're calculating the amount, the life expectancy factor, you want to use the age that the individual is at the end of the year. So if you're having a conversation with someone who's 55 years old today, but by the end of the year, they're going to be age 56, then you want to use age 56. Another planning opportunity here, play around with the life expectancy table and see which one gets your client closest to the amount that they need. We look at this calculation here, where on the left-hand side, we're using the joint life expectancy table, and on the right-hand side, we're using the single life expectancy table. You'll see using the other factors, the amount using the joint life expectancy table is $25,000 plus, whereas using the single life expectancy table, it's $30,000 plus. And we're just looking at the annuitization method. Same thing for the amortization method. The amount is higher when you use the single life expectancy table. Now, the account balance must be reasonably determined. When you're calculating the 72T amount, the formula requires inputting the account balance. And for the RMD method, the account balance is determined just as you would determine the account balance when you're calculating a regular required minimum distribution. For the fixed amortization and fixed annuitization method, the account balance must be determined in a reasonable manner depending on the facts and circumstances. Now, according to the official guidance, this means if you're calculating the amount today, you can use the fair market value as of December 31st of the previous year, from then up to any day up to when the calculation is being done. But part of what you're going to look at, let's say during the year, something happened and the market spiked significantly, went up 200%. Can you use the market value for that day? Probably not, because that would not seem like a reasonable determination of what the account balance is. Rule number 7, no changes to the account balance are permitted once you have determined to start a 72T program, which means you cannot do any partial transfers in or out. You cannot take a distribution and roll it over to another account. The only additions that can be done to the account are gains and losses on the investments. So one of the things that we always want to bear in mind is that 72T accounts must stand by themselves. If your client wants to add new contributions, they have to do that to a different account. Which is why when someone starts a 72T program, one of the things we usually recommend is that make sure that they know that once the account starts, nothing else can go on with that account other than taking the 72T distribution. Now, that account can be converted to a brand new Roth IRA where the individual continues to take the 72T payment. They can also do a full transfer of that account to another brand new IRA or account and continue taking the 72T payments. But the key is you do not change the balance of the account under which the 72T program is being done by bringing in new amounts or taking a portion of the account, of the assets from the account. Full transfers, yes. Partial transfers, no. The payment frequency cannot be more than annually. So your client can take payments daily, weekly, monthly, every 6 months, every quarter, but they can't say, I'm only going to take my 72T payments every 2 years, because the frequency cannot be less than annually. And a SEPP must not change before the modification date. Now, let's say your client's 72T payment is $50,000 per year. Then they have to continue taking $50,000 per year for 5 years or until age 59 and a half, whichever is later. There are exceptions to that rule. If the account owner dies, if the account owner becomes disabled, or if there's complete depletion of the account, then those are the exceptions to that rule. Let's take a look at some example with when really is the modification date. Let's assume that Jack starts a SEPP at age 56 on December 1st, 2021. Jack can only take these 72T payments, no other types of distribution, until December 1st, 2026. Right, so Jack has to take payments at age 56, 57, 58, 59, and 60. If Jack takes any other payment before the modification date, then that would be considered a modification, which means the rules are broken. And I'll talk about what it means when the rules are broken in a second. Let's take a look at another example where Sharon starts a 72T program on December 1st, 2020, and she reaches age 59 and a half on July 1st, 2026. Now remember that payments must continue for 5 years or until age 59 and a half, whichever is longer. Sharon may not take a different distribution other than the 72T payment or alter the amount until July 1st, 2026. Now, I want to tell you about a case, though, where someone was operating a 72T program in an IRA, and they took an additional amount for higher education expenses, which qualified for an exception to the 10% early distribution penalty. And the IRS noticed on the 1099-R that the amount had increased. And so they tried to disqualify the 72T program, but the taxpayer disagreed with the IRS, took them to court and won. The tax court said, listen, the additional amount that was taken was for higher education expenses. That qualifies as an exception to the 10% early distribution penalty. Therefore, that does not result in a modification. What does this really mean? It means that sometimes it makes sense to hire an attorney, especially if the amount is significant enough. If your attorney, especially if your tax attorney, determines that there is some other interpretation here that could allow your client to get reprieve from the recapture tax, which is what I'm going to be talking about here for rule number 10. What happens if someone breaks any one of those rules that I just talked about? Well, that would be considered a modification. And when a modification occurs, then there's a recapture tax. What does this mean? Let's assume that someone starts a 72T program at age 50. And at age 55, they did something that resulted in a modification. Now, from age 50 to 55, they weren't paying the 10% early distribution penalty. But now that there is a modification, all the penalty that was waived from age 50 to age 55 now becomes due to the IRS. So they're going to have to pay all that penalty that was waived plus interest on that amount. So you can see it's pretty risky to break any of the rules, which is why when you have clients who are considering starting a 72T program, you want to make sure that they're clear about the rules that should be followed and the consequences of breaking those rules. Now, one of the questions that usually comes up is, what if my client is running a 72T program and a traditional IRA, and we determine that doing a Roth conversion is a good idea for that client? Then that's perfectly fine. You want to make sure that the Roth conversion is done to a Roth IRA that does not have any other assets, because that no commingling rule continues to apply. And then they have to continue taking the 72T payments from the Roth IRA up until the modification date. Now, when we talk about 72T programs, there is not a lot of official guidance out there, as there is with some of the other rules that govern IRAs and employer plans. And so sometimes, even though private letter rulings can be relied only by the individuals to whom they are issued, they do give you some insight into how the IRS might respond if something comes up with a similar fact pattern that is addressed in a private letter ruling. So I thought, why not briefly talk about some of these? In private letter ruling 199943050, this taxpayer said to the IRS, cost of living has gone up, and I think I need more money to cover my living expenses, and that's what I'm doing with my 72T. Why not increase my payments by cost of living increase? And the IRS said, no, can't do it. In 2002-7060, someone had to give up some of their IRAs under a divorce decree. And the question that came up is, if someone have to give up 50% of their IRA, should they continue taking the original amount of the 72T payment? And the IRS said no. If you gave up 50%, you can reduce your payments by 50%. And guess what? The spouse that receives the 50% that you gave up does not have to take 72T payments from that amount. Under 2004-32021, the IRA owners were allowed to refigure annual amounts each year, even though they were using the amortization method. Now, remember earlier I said once you start under the amortization or annuitization method, then you're locked into that amount. But the IRS made an exception for this person. Now, when someone starts a 72T, remember I said the same amount must be taken each year. Now, in this particular private letter ruling 2005-03036, the IRA custodian got the request and didn't process it until the next year. Now, what does this mean? Ding, ding, ding. The IRS gets a 1099-R that shows the amount is not what it should be. But once they were told and provided with proof that it was the financial institution's mistake, they determined that did not result in a modification. And in 2009-25044, someone decided that they wanted to do a partial transfer of the account from which they were running a 72T payment, and that resulted in a modification. Now, we cannot talk about 72T payments without talking about the tax reporting that is done. Because in addition to the tax reporting that's done on the tax return, there is, of course, what the IRS reports on the 1099-R. Now, whenever distributions are taken from a retirement account, the plan trustee or IRA custodian must issue a Form 1099-R. Now, in box 7 of that Form 1099-R, the issuer is required to input a code. And the code lets the IRS know what type of distribution is this. And in most cases, that code indicates whether the distribution is subject to the 10% early distribution penalty. Now, if the account owner is under age 59 and a half, unless they qualify for an exception that the custodian is required to report as an exception, the custodian will input code 1. Code 1 says to the IRS, this person is under age 59 and a half. Therefore, this person is subject to the 10% early distribution penalty. The thing is, sometimes the IRA custodian is allowed to use code 1, even though the IRA owner or plan participant does qualify for an exception. I'll talk about, well, what do we do in that case then? I'll talk about that in a little bit. Now, there are some instances where if an account owner qualifies for an exception, the custodian or plan trustee uses a code 2 in box 7. Code 2 says to the IRS, this person is under age 59 and a half, but I know that they qualify for an exception. And when code 2 is used, the IRS usually takes that as truth and do not apply the 10% early distribution penalty. Now, a 72T payment is one of those exceptions where the IRA custodian or plan trustee can use a code 2. But guess what? The instructions also say to the IRA custodian, if you do not know whether the taxpayer meets the requirement for a 72T payment, use a code 1. And so you have an increasing number of IRA custodians that are saying, well, we don't know if you meet the requirements, so we're going to use a code 1. Even if the IRA owner provides them with the calculation and a certification from the accountant, they're taking the position that we don't want that responsibility. We're going to issue a code 1. So what happens when the IRA custodian takes that position? Well, the tax preparer would file Form 5329 to override the Code 1. Now, when you look at the instructions for Form 5329, it gives you different codes that can be used to override Code 1. And on the Form 5329, Code 2 would be used if distribution is part of a 72T payment program. Now, once an individual reaches age 59 and a half, the code should be 7. 7 means that the distribution is normal and is not subject to the 10% early distribution penalty. But there's an exception to that. If someone is age 59 and a half and the IRA custodian had been using a code 2 because they know that the 72T payment exception applies, but the IRA owner does something that results in a modification, then even though they're past age 59 and a half, the issuer, custodian, or plan trustee would use a code 2. Let's look at an example where Mr. B began receiving 72T payments when he was 57 years old. And the IRA custodian, knowing that, would report those payments with a code 2. But at age 61, Mr. B modified the payments. Now remember, he has to go on for 5 years or until age 59 and a half, whichever is longer. So the 5-year period is what applies in this case, but he modified the payments at age 61. In that case, even though he's age 61, which is over age 59 and a half, the custodian would use a code 1 to report the distribution thing that is addressed by the IRS. So just make sure that your client talks to their tax advisor to make sure that the 72T program is well in all aspects with the IRS. Some general tips and reminders. Remind your clients to be very careful when they're running 72T programs. And of course, only clients for which they're suitable should start these in the first place. My recommendation is to provide a checklist for your client because this is not their area, obviously, and sometimes they forget. Provide a checklist. Take the fixed amount each year. Do not add any amount, do not bring in any new funds, do not take any partial transfers. And of course, if the custodian does not report the distribution as being qualified for an exception, then the tax preparer would use Form 5329 to override the custodian's reporting. And keep SEPP accounts separate from all other accounts. If your client wants to do other type of transactions, then the other accounts that are not part of the 72T program can be used for those. I welcome your questions. This is my email address that you can send your questions to. And I want to thank you for staying here with me. Let me see if any questions in. Can I get a copy of the presentation? Absolutely. That is part of your handout. You do get a copy of the PowerPoint handout. And in addition to that, I provide you with a copy of my 72T cheat sheet. So hopefully you find that helpful. Do you calculate 72Ts? No, I don't. I defer to an individual's tax professional to calculate their 72T schedule. Some financial institutions do provide software. They usually hang it on their website so individuals can use it. And I've found in rare cases where some financial institutions actually do the calculation. What if someone starts at age 40? Are you saying that they have to go on until they reach age 59 and a half? Yes, which is why you want to carefully assess whether should someone start at age 40 what is that, 19 years that they have to continue for? Do they really need the funds for 19 years? Because once they start, they can't stop until the modification date unless they're willing to pay all the penalty that was waived under the program. So that has to be, if someone is already retired at 40 and they're going to be taking distributions anyway, and they need that fixed amount each year, then that makes sense. But this just says that we have to look at each individual's distribution, tax planning, retirement profile, and determine if they are a suitable candidate or ideal candidate for a 72T program. You said account balances can run out, but you also said they can't run out. No, I think I know what you're talking about. All things being equal, a 72T program is not going to deplete an account balance. But when the IRS issued revenue ruling 2002-62 in 2002, there was a huge market downturn then. And a lot of people who had started 72T programs found that their account balance were depleting much faster than projected. Some of them was even running out of money. And that was one of the reasons for issuing revenue ruling 2002-62 to say, well, what happens in that case? And so the IRS says, okay, well, if you run out of money, there's nothing that you can do, and except stop. And in that case, an exception was made where that would not be considered a modification. What's the highest interest rate it can be used? Can I use 10%? No, you can't use 10%, because remember, the the cap is 5% or 100% of the long-term capital gains rate. Great job, Denise. Thank you. I don't see any more questions. I just see a lot of thank yous. I appreciate that so much. Thanks for staying with me. Enjoy the rest of your day. Thank you.